Unilever has been on my watch list for quite some time. Today's episode, we're going to find the answer to, is it a buy now? We're going to take a look at historical performances of the company. We're going to jump in and look at the income statement, their revenues progressively over the last 5 years, see how that has affected the bottom line. We're going to jump in at their balance sheet, look at their cash versus their total debt position. We're going to also look at that dividend safety. Are they able to continue paying dividends, paying off their interest and their debt? And as always, we're going to get to the end of the episode and look at that stock valuation model. What is the intrinsic value of Unilever and what is our acceptable buy price given that margin of safety? Now, taking a look, they are up 3% year to date, and we can see they are heading towards that mid to upper range of that 52-week low and high. Currently offers a yield of 3.61%, which isn't bad in today's market. And for those who have been holding for 10 years, you would be up a measly, and I mean measly, 27.64%, even though that doesn't take into account dividends reinvested. In my opinion, that is very, very low. Now, let's take a look and see whether or not there is opportunity for us to buy Unilever at a good price and make some money, not only on that dividend yield, but also the share price appreciation. Now, Unilever in December 2018 reported revenues of 58.4 billion. Typically, we like to see increases of 3 to 7% year on year for slow, moderate, steady growth companies. Now, we can see here in 2022, they reported 64 billion. So there is an increase over the 5 years. However, when we look year on year, we can see a truer picture. Very minimal movement between 18 and 19. Nice movement 19 to 20, and then we do see a decrease from 2020 to 21, and then that increase from 21 to 22. Now, this is why I like to look at data for at least 5 to 10 years for a company to get a good sense of the overview and how the business is run and their performance. Now, let's see if that's come down to the bottom line. So in December 2018, they reported a net income of 10.7 billion, and in 2022, there is a drop down to 8.2 billion. So as we can see here, they have not been increasing that net income over the last 5 years, which is a slight worry, and we'll take a look at that further when we come to look at our financial metrics. Now, the balance sheet, what we want to have a look at here now is their cash movement over the last 5 years alongside that total debt comparison. Now, December 2018, they had total cash and short-term investments of 4.9 billion. And in their latest quarterly report, we can see here it's increased to just under 6 billion. So nice increases over the last 5 years. And now let's see how that compares to the total debt balance. Now we can see here their total debt in 2018 was 30.6 billion. And we can see in their latest quarterly reports 5 years later, it is slightly higher at 31.6 billion. Now there isn't that much of an increase over the last 5 years, but it's important to check this against their dividend safety and also their financial metrics to ensure they are able to continually, 1, pay off that dividend, 2, pay off the interest, and 3, at some point, pay down that debt. Now, their dividend safety is sitting at 75, a safe score, a market cap of 131 billion, making it a mega cap. Now, looking at some key metrics, we can see here they have been paying dividends for 26 years without a reduction. And some positive news if you think we are looming or heading into a recession. We can see here they increased the dividend during the previous recession, 07-09. And their sales, whilst being negative 2% in this period, it was above the average growth. And even though you can see here a negative 44% return in the recession, it still beat the S&P 500's negative 55% return during that period. Now, you know that I like to hear 4% dividend increases at a minimum because the US inflation rate over the last 40 years was in fact 4%. So if you are getting less than 4% in your dividend increases, your salary increases or other income producing assets, you are losing your purchasing power and in fact getting a pay cut. Now, what we can see here is the reason why this may not be slightly similar to the UK where Unilever pays out its dividends is due to the FX rates. So for the UK holders, you may notice a slight difference in these percentages. But what we can see, and this will be the same for UK and US, is that the dividend has been growing for over 26 years, meaning that given it's more than 25 or 25 plus years, they are a dividend aristocrat. And the last 10 years, a 6% per year increase year on year, which is above inflation, is a positive. Now, dividend yield theory states that a company is undervalued when the current yield is sitting above the 5-year average. So what we can see here, based on dividend yield theory, it looks to be it looks to be reasonably valued. But again, we don't look at any model in isolation. We look and draw our conclusions at the end. The forward PE, fairly in line with the 5-year average. Again, another indicator of being reasonably valued. And the sector PE at 21.8 is slightly higher than the Unilever PE ratio, coming in at 18.1. Now, as mentioned, it is heading towards the upper end of the 52-week high. However, this is more for information purposes. If it was at the top end, it wouldn't mean it's overvalued. Likewise, at the bottom end, it wouldn't mean it's undervalued. Now, earnings payout versus free cash flow payout. For those that are new to the channel, we only look at the free cash flow payout, given the earnings is susceptible to manipulation by management through accounting. Either way, I personally like to see below 60%. If you see in my pinned video, you'll see one of my 7 golden dividend metrics. Below 60% means that there is room to grow double-digit dividend growth in that dividend that you receive year on year, quarter on quarter. We can see here for the earnings, it is slightly above that, but it's still in the 60s, which for me isn't that bad. Likewise, with the free cash flow, it's still in the high 60s to low 70s. Ideally, I would like it to get closer to 60, and we can see here in 2023, 68%. It's not the end, or it's not the be all end all for me. I would still consider it around the late 60s and low 70s, but it's preferable for me to be under the 60% for reasons mentioned. Now, likewise, I prefer to look at the free cash flow per share, but I think they essentially mirror a very similar story. On the earnings per share, 158 in 2013, 257 in 2022, and in 2023 is expected to be 261. So whilst there is growth over the period, it is very slow and it is not that consistent. We can see slight increases, a larger increase. Likewise, with the free cash flow per share, 145 in 2013, 219 in 2022, and in 23 expected to be 255. So this is probably something I would look at year on year just to ensure that it is creeping upwards and it's not going back down. You always want your free cash flow per share and earnings per share to be increasing. Now, sales growth. This is one which I think Unilever struggles quite a bit when we talk about steady, moderate growth of 3 to 7% year on year in the sales. We can see here there have been, in fact, at least 5 years where there's been negative growth. Whilst we have seen some double-digit growth, it's not really what you want to be seeing, and we can translate this below into their total sales. 2013 revenues of 50 billion, 2022 60 billion. So ideally, you'd be wanting a larger increase, 3 to 7% year on year. But unfortunately, some of these negative years have really killed this ideal scenario that we would like to see. So I would really urge you to keep looking at their quarterly report, their forward guidance, to ensure that they are able to continue growing that revenue, not only 3 to 7%, but also do take into account that if inflation is increasing quite high, you would also expect their sales to increase too. Now, shares outstanding, typically we love it when companies return excess cash to shareholders, and we like to see a declining graph. Not much share buybacks happening with this company. As we can see, there are the odd year or two here where they do a buyback, but nothing really that big to really discuss. Return on invested capital, again, do watch my video on how to analyze stocks, one of my 7 golden dividend metrics. 10% minimum for return on invested capital metric, as it means the company is able to allocate their capital efficiently and restore some faith in management. We can see here above 10%, which is very positive to see, between 18 to 28%. As long as this stays above that 10%, I'm very happy as a shareholder. Operating margin and free cash flow margin, you could argue, as we've seen if you've been watching my videos, a lot of these consumer staple companies do struggle with their margins. We can see here it has been around 60%, so that is positive to see in my opinion. Likewise, this has been above that 7% we like to see for these types of companies. So I would say these are fairly positive. So very nice to see on the margin basis. Now, net debt to earnings before interest, tax, depreciation, amortization. As I did mention, their debt was fairly high. It hadn't really moved over the last 5 years, but purely based on the fact that it is below the 4 we like to see for consumer staples, and it's significantly below 4, I would say this is positive. And for me, there are no real issues with their debt levels currently. Net debt to capital just showing that 2022, 54% of the company's financing was from debt rather than equity. So there are some good things to note with Unilever. There are some elements that we will be looking in their next quarterly and annual report and forward guidance, but so far there is no real red flag currently. Now, the stock valuation model, we're about to run through this now. If you're enjoying the content and the value is being added, do smash that like button, do hit that subscribe button for continued content. If you want to pick up a copy of the valuation model, do check that pinned comment. And if you want to join us over at Patreon with our investing community, do come and join us. Now, the stock valuation model, we're going to jump straight into Graham's valuation. The earnings per share coming at $3.26, with analysts estimating growth rates of 7 for the foreseeable future, and that current yield on AAA corporate bonds at 4.73. Now, according to Graham's valuation, the intrinsic value is just under $43, and therefore it is lower than the current share price and right at that 52-week low. Now, moving on to the multiples valuation, we have companies in a similar sector and industry. We have Colgate, Palmolive, Procter & Gamble, Kimberly-Clark. Once we get the stock price and EPS, we get the P multiple, which we multiply the average by the earnings per share. This gives a stock price of $98 for Unilever, which is quite high and higher than that 52-week high. We then move on to the dividend discount model, and again, whilst we can see an average growth rate of 1.5%, this will be slightly different for UK investors due to the fact that the FX rate will affect the growth rate in terms of the US, depending on what their yearly dividend payout would be. Now, forward looking, I've gone for around 5.5%, slightly higher than inflation. I do believe they will start to increase this, and the latest increase was around 9% for the UK investors. So the DDM price comes out to $79.37, showing some nice upside to that current share price. Then we move on to the DCF model, the discounted cash flow model, where we have the free cash flows year on year, the growth rate year on year, and this comes to an average growth rate of 2.88%. Analyst estimates around 4% moving forwards for the company. Alongside using our discount rate, we get the present value of these future free cash flows and the terminal value, which we add, including the cash, subtract the debt, get to our equity value. Once we divide by the shares outstanding, we get a DCF price of $37.54, slightly lower than that 52-week low. Now, if you are enjoying the content, as always, do hit that like button and do hit that subscribe for continued content. Now, the intrinsic value is essentially the average of the four models that we have just gone through, and it comes to around $64.34. So we can see here slightly higher than that 52-week high. Now, the current share price is sitting around $52.13. Now, typically for a company with a strong moat and a wide moat, strong historical data and forward-looking guidance, typically, and good financial metrics that we discussed, I'd be looking for a margin of safety around 10%. So you'd be looking to buy around $57.90, which would mean it's a current buy now. But for a company like Unilever, given the way their revenues has been dropping and the way there are some metrics we discussed that we would like to keep an eye on, such as their sales, I would personally say around a minimum margin of safety around 20%, meaning your acceptable buy price would be around $51.47. Preferably, though, I would be looking probably for a margin of safety of around 25%, meaning I'd be looking to buy around $48.25 personally, which is still within that 52-week range. As always, let me know your thoughts in the comments. Are you looking to buy Unilever? Are you on the sidelines, or are you a current shareholder unsure what to do? Wall Street have forecasted, however, the price to hit around $56.15 over the next 12 months, showing there is still some slight room for growth in terms of the current share price. As always, have a great day. Catch you on the next episode and take care.